What is a tax base in progressive taxation? Imagine a system where everyone pays their fair share, but those with more resources contribute a bit more. That's the idea behind progressive taxation. But how does the government decide who pays what? The answer lies in understanding what is called the tax base. Think of the tax base as the total amount of money, property, or assets that can be taxed. It's like the foundation on which the government builds its tax rates. In state policies and laws, the tax base can include different things depending on the type of tax. For income taxes, it's the total income a person earns from wages, salaries, investments, or dividends. For property taxes, it's the value of real estate or other assets like stocks or savings. Some states also tax inheritance or estates, and in those cases, the tax base is the value of the estate or inheritance. States set specific rules to define what counts as taxable within the tax base. They create brackets or thresholds, which are like steps. For example, the first $50,000 of income might be taxed at a lower rate. Any income above that amount could be taxed at a higher rate. This setup makes sure that people with higher income or wealth pay more in taxes. The goal of defining the tax base clearly is to make the tax system fair and easy to follow. It helps prevent confusion and ensures everyone knows what is taxable. When the tax base is broad, it includes more types of income or assets, which can make the system more progressive. If it's narrow, fewer things are taxed, and the system might be less fair. In the context of state laws, the tax base is carefully chosen to balance revenue needs and fairness. It's a key part of how states design their tax policies to reflect their priorities. The larger the tax base, the more money the government can collect without raising rates too high. So, in simple words, the tax base in progressive taxation is the total amount of income, wealth, or assets that the government can tax. As the tax base increases, the rates go up, making sure that those with more resources pay a bigger share. This approach helps create a fairer system where everyone contributes according to their ability to pay.